Hey everyone, thanks for checking into Stock Investing and Trading 101. Today I'm making a video. We're going to be discussing dividend yield trap. What this is, it's a way for stocks to entice rookie or new investors. Typically these stocks have a very high dividend yield, excess of 20% or 18, to 20 to 30% even. And so these companies advertise a incredibly high dividend yield, which is very attractive to rookie investors. But these stocks also have big issues with them usually, and that's why they're advertising this crazy dividend yield. So to show you guys some of the issues with these dividend traps, I'll be showing you guys some of the long-term charts for some companies that have very high dividend yields. The first company we're going to start with was IIF, and I looked these companies up on Dividend.com. I looked for highest yield, and I picked some of the companies that I saw with the highest yield on that search. And the first one I see is IIF. This one has a 41% dividend yield. So someone might see that and be like, holy crap, 40% dividends, that's insane. And as you see with this, this is a 3-year chart. This stock price has been performing very bad for the last 3 years. Most of these dividend yield traps are all downtrending stocks. So if you would have invested about a year and a half ago at $36, your investment would only be worth half the value now at $18. So you might have gotten that dividend yield, but your investment's lost half of its value in the meantime and is continuing to go down. And who knows if this dividend will get cut in the future or not. That's typically these dividends are very unsustainable, meaning they won't be able to pay this dividend out for very long. These companies usually have a very high yield. They have excessive debt. Their dividends are greater than their earnings, so they're paying out more than they're taking in, which is a clear sign that a dividend is unsustainable. If they're giving away more than they're making, obviously that won't be able to be managed for very long. Also, negative cash flow, which goes along with the what I just mentioned, and they usually have problems with the business. So these really are kind of I don't want to say predatory, but when these dividend yields are advertised, it's typically to entice the new investors. Most seasoned investors would see something like this with the 40% dividend yield and know that this is a trap right here. It's called a yield trap. And there's tons of companies that try to do this. The next one we'll do is CNSL. This one has about a 32% dividend yield, and this chart is just terrible. So if you invested about 3 years ago at $30 per share, your stock now is worth about maybe $5 per share, so 1/6 of the value. So you lost, over 75% of your investment price. And even if the dividend was being paid out this whole time, it wouldn't have made up for all the losses that you would have incurred. And the thing is, these dividends are eventually or may have already been cut. So once a dividend gets cut, especially on something like this, the stock price is just going to tank. So that might be, I'm not exactly sure what happened with the stock, but it's made a couple big downturns, and this is probably because of a possible dividend cut or just terrible earnings, where obviously they're not going to be able to pay this dividend out for long. And so these are the type of companies that are advertising these high dividends. Most solid blue chip companies aren't paying dividends much higher than, I think, like 6 to 7% would be a very, very attractive yield. I think a more reasonable yield would be like 3 to 5%. So if you see a company paying 10, 20% dividend yield, I would definitely look further into it to see, why they're paying so much yield. One thing to look for when you're looking for a good, solid dividend stock that to invest in, what you're looking for, just a few things are recent earnings growth. So if they're just making less money every year, or there's not much growth, there won't be much room to grow the dividend, and it could also possibly get cut. Also, you're looking for a reasonable PE ratio, which is a price to earnings ratio. You're also looking for a history of dividend growth with no cuts. So a company like Altria, who's been growing and paying dividends for many years, has a solid, proven track history. A company like this, or some of the other ones that I've mentioned, probably don't have much of a track history, and it's definitely probably not a good track history just from looking at their chart. This is another one. This is JBR. They pay about a 29% yield, and I mean their stock price is down about 75% in 3 years. So if you invested $100, you would only have $25 worth of stock right now. And even if you were receiving this dividend, it just wouldn't be worth it the whole time. I know me myself, when I first started investing, I was uh, lured into these yield traps, and luckily I didn't really make too big of mistakes or lost too much money from them, but I did realize really quickly that these aren't the kinds of companies that I wanted to invest in. I want to invest in a company that can afford its dividend and grow it at the same time, and a growing company, not something that's obviously not growing at all. It's actually moving backwards. So next we'll go to PFH. This also pays 29% dividend yield, and you see the chart on all these companies. They're all different companies, but they all look the same. It's a very steep downtrend in 3 years. I mean, they're all down at least 50% or 75% in some cases, and they're just majorly downtrending. Next, we'll look at CLM, which is actually a stock that I at one point was pretty heavily invested in, and I still am currently invested in. So this stock does have all the characteristics of a yield trap. They're paying the extremely high dividend. Their stock is downtrending. I actually follow this company somewhat closely, so I see their earnings, and essentially their dividend isn't paid from earnings. It's actually paid in capital. So essentially what they're doing is raising capital and just paying it out. They're not really making any money, and uh, the money they do make is not very much in essence of how much dividends they're paying. I believe this company pays around 20 cents dividend per month, or maybe 22 cents, and I think 20 out of the 22 cents comes from paid in capital, meaning they're just paying out what they raised. It's not really a good business model in my opinion, but for me, I was able to keep some profit, and like I said, the dividend is pretty nice for me. So what I do is just really watch my average price. I'm really not trying to pay. I'm trying to catch it at the bottom. Maybe I'll pay $11 per share because this thing is probably going to continue to downtrend. So just keep that in mind. I would most likely just avoid yield traps unless you really wanted to experiment or take a gamble. And here's another one. This company pays around 20% as well. 3 years ago, it was worth $31 or $32, and now it's worth about $6. So it's only worth 20% of its original value, which is no good. This isn't a company you want to invest in. At least I wouldn't invest in. And here we go, another one. This one pays 18 cents. This is COHN, and they went from 16 to $4. So you see, it's the same story with pretty much all these stocks, and you could find a million of them if you go to the Dividend website like I did and just search for yield and search for the stocks with the highest yield. You'll probably notice that almost all of them are yield traps. It's very unlikely that a company would be able to sustain this high of a dividend unless it was some kind of, crazy good company. And even in that case, the top companies, we'll go with Apple, Microsoft, Johnson and Johnson, Procter and Gamble. These companies don't pay that high of a dividend yield because, they're such good companies, and it just wouldn't make sense for them to do that. So really that's what I wanted to discuss today, because this is something that can confuse a lot of new investors, and I know me myself, I kind of fell for the dividend trap and was chasing yield, and that's the last thing you want to do. When you're investing in a dividend company, you really should be looking at their financials and seeing, how much money they're making, if their income is growing every quarter or every year, how they're performing, how their dividend is being raised, or if it's being cut or not. And these are all factors that you need to know before you should really be investing in any dividend company, or any company for that matter. So just make sure you are looking further into the company than dividend yield. If you see a high yield that shouldn't be the reason that you enter a position in a company. A high yield is actually kind of a turnoff for me. If I seen an incredibly high yield, I would probably stray away. The only uh, high yield dividend trap-ish stock that I'm currently watching is CLM. And once again, I've already explained it that I didn't lose money on them. I'm making a little bit of money, and my position is pretty small. So these are risky companies, extremely risky companies compared to a blue chip company. So if you guys have any questions about yield traps, definitely feel free to ask me. It's something that you should be at least cautious of and know what these companies are and what they're trying to do. They're trying to trick you into investing in a crappy company. So hope you guys learned something today. Thanks for checking out my video. Check out my other videos, subscribe to my channel, and we'll see you guys soon.